The year is 1980. In a drab government office in Washington, D.C., a benefits consultant named Ted Benner is poring over a new, obscure clause in the tax code. Section 401, subsection K. It's an almost forgotten provision, intended to let executives defer compensation. But Benner sees something no one else does. He doesn't see a niche tax break for the wealthy. He sees a key, a mechanism that could unlock a revolution in how ordinary people save for retirement. He sketches out a plan, a radical new kind of savings account where an employer's own contributions could be matched by their employer, tax-free. He pitches it to a client. They reject it. Too confusing, they say. Too risky. But Benner is convinced he's found a loophole that could change everything. The question wasn't if it would work, but what it would become. How did this accidental discovery, this legislative footnote, quietly grow into a multi-trillion-dollar system that now holds the retirement dreams of over 100 million Americans? This is not just a story about a savings plan. It's the story of how the very concept of retirement security was dismantled and rebuilt, creating America's biggest, and perhaps most fragile, piggy bank. Before the 401k, the retirement landscape in America was built on a simple, powerful promise. It was called the defined benefit plan, known to most as a pension. You work for a company for 30 or 40 years, and in return, that company guarantees you a steady, predictable income for the rest of your life. The risk was on the employer. They managed the investments, they absorbed the market downturns, and they were legally obligated to deliver on that promise. This was the bedrock of the post-war social contract. A lifetime of work for a lifetime of security. But by the late 1970s, this bedrock was cracking. American corporations, facing stagflation and fierce global competition, began to see pensions not as a promise, but as a liability. A pension was a financial ball and chain, a drag on corporate balance sheets that stretched decades into the future. They needed an escape. And then, Ted Benner found one. His interpretation of Section 401k offered a brilliant solution for corporate America. It shifted the entire paradigm. Instead of a defined benefit, it created a defined contribution. The company no longer promised a specific retirement income. They only promised to contribute a specific amount to an account. The responsibility, the risk, the entire burden of securing one's future was transferred from the institution to the individual. The pitch was genius in its simplicity. It was framed as empowerment, as giving employees control over their own financial destiny. You choose your investments. You watch your money grow. It's your account, your future. Companies eagerly adopted it. It was cheaper, it was predictable, and it severed that long-term, legally binding pension liability. The 401k wasn't sold as a replacement for the pension. It was introduced as a supplement, a nice little extra savings tool. But in the ecosystem of corporate finance, the cheaper, less risky organism always wins. Within a decade, companies began freezing their pension plans, one by one. The 401k was no longer a supplement. For a new generation of workers, it was the only option. The rise of the 401k didn't just change retirement, it ignited an entirely new industry. Suddenly, tens of millions of ordinary people, most with no financial training, were transformed into amateur investment managers. This created a massive, captive market, and Wall Street was ready. Mutual fund companies, brokerage firms, and financial advisors descended, offering a dazzling array of investment options, all neatly packaged for the 401k menu. The system spread like wildfire. By the year 2000, 401k assets had swelled to over $2 trillion. It became a pillar of the American economy. But inside this incredible growth story, a hidden flaw was metastasizing. The flaw was baked into its very design, the illusion of choice and the reality of complexity. The average 401k plan presents employees with a list of mutual funds. But these aren't just simple choices. They come with expense ratios, management fees, 12b1 fees, administrative costs, a web of hidden charges that slowly, almost invisibly, erode returns over time. A 1% annual fee might sound trivial, but over a 40-year career, that 1% fee can consume nearly 1/3 of your potential retirement nest egg. The system that promised empowerment was quietly siphoning off a significant portion of the wealth it was meant to build. This wasn't a secret conspiracy. It was the business model. The entire financial advisory complex was built to profit from the management of these massive, aggregated pools of capital. The central paradox was this: the 401k gave individuals all of the risk, but it gave the financial industry a guaranteed, low-risk revenue stream skimmed directly from the savings of millions. The ticking time bomb wasn't the risk of a market crash, but the slow, corrosive certainty of fees. Let's diagram the mechanism. Imagine your paycheck is a bucket of water. A portion of that water is diverted into your 401k bucket. Your employer might add a bit more water. This bucket is then handed to a financial company. Now, this company doesn't just hold the bucket. They punch a few small holes in the bottom. One hole is labeled management fee. Another is administrative cost. Another, trading fee. Each year, a little bit of your water leaks out through these holes. It doesn't seem like much, but over decades, the total amount of water lost can be enormous. Meanwhile, you're told to focus on the water level, which goes up and down with the rain of the stock market. You're so busy worrying about the weather, the market's performance, that you don't notice the persistent, deliberate leak draining your resources year after year. This is the architecture of the 401k fee structure. The catalytic failure of this system wasn't a single, explosive event. It was a slow-motion crisis, revealed by two major market crashes. First, the dot-com bust in 2000, and then the global financial crisis of 2008. For the first time, an entire generation of workers nearing retirement saw their 401k balances evaporate, dropping by 30, 40, even 50%. Unlike a pension, there was no backstop. The losses were theirs alone. People who had planned to retire in their early 60s were suddenly forced to work another 5 or 10 years, just to recoup what they had lost. The crisis exposed the raw vulnerability of the individual investor. The promise of control was revealed to be the freedom to fail. The fallout led to a wave of regulatory scrutiny. The Pension Protection Act of 2006 tried to patch the system, introducing auto-enrollment and default investment options like target date funds. These were designed to be simple, set-it-and-forget-it solutions. But this brings us to the modern landscape. The 401k is now more dominant than ever, with assets exceeding $10 trillion. Target date funds, the supposed fix, have become the default for millions. Yet they carry their own hidden risks. These funds automatically shift their asset allocation from stocks to bonds as you age. But there is no standard for how aggressively they do so. Two different 2045 target date funds can have wildly different risk profiles and fee structures. This thread of engineered complexity continues. The modern 401k is now being targeted by private equity and other complex, high-fee alternative investments sold under the banner of diversification. The fundamental mechanism remains the same: a captive pool of money managed by individuals who are structurally disadvantaged against the financial firms selling them the products. The analytical takeaway is this: when evaluating any retirement system, you must ask 3 questions. First, who carries the risk? Second, who profits from the complexity? And third, how much of my growth is being consumed by fees over the long term? Answering these reveals the true nature of the system. So, we return to that consultant in 1980, sketching out a plan based on a legislative loophole. Ted Benner wasn't a villain. He was an innovator who unleashed a force he couldn't have fully understood. He saw a way to help people save, but in doing so, he provided the tool that allowed corporations to shed their oldest promise to workers. The 401k system he sparked became a marvel of capital accumulation, but it was built on a foundation of transferred risk and hidden costs. Understanding the 401k isn't just about managing your own account. It's about recognizing the architecture of modern retirement. It's about seeing the shift from a system of collective, guaranteed security to one of individual, market-based risk. This is the true story of America's biggest piggy bank. It was not given to you as a gift. It was sold to you as an opportunity, and its price is a lifelong responsibility for which most of us were never trained.